What's cracking, investors? Well, I was listening to a finance show today, found out about BOXX, which is an ETF that always goes up. No joke. So the finance show that I was listening to is Market Huddle. I really love that show. I recommended some side effects to them. They actually used them, which was awesome. And hopefully they answer my question. I had a question for them. Hopefully they answer that in the next episode. So I want to tell you about BOXX, right? So they had the guy that runs it on their show, and I want to give you a little overview of it. Now, I'm obviously not paid promoter or anything like that. I just thought it was interesting, so I thought I'd share it with you. So the ETF looks like this. And tell me, guys, have you ever seen such sorcery? Always goes up. The inner workings of it are pretty interesting, actually. I'll get into that a little bit. But basically what it does is it replicates the Fed's fund rate, more or less. When I was reading through the prospectuses and all the documents, associated with the ETF, I found out a few important things. First, how much it costs and what the expense ratio is. Now, the gross expense ratio is 0.3949, which is almost 0.4%. It's very high. But until I think November 2023, they've lowered it to almost 0.2 for the time being. I don't know if it's going to go up from there, but if this ETF continues at its current pace, then it's probably going to return, north of 5%, almost 5.5% probably by the end of the year, which is spectacular considering it's pretty much risk-free. Now, the big question is, first of all, before we dive into the big question, okay, let's talk about its competitor. So the competitor of this ETF is SGov. So if you didn't know about SGov, let me pull it up over here, which is a 0 to 3 month treasury bond tracker instead of a 1 to 3. And it looks something like this. Okay, so what it does is actually pays a monthly dividend. So if you prefer that, then you're better off going with SGov, SGOV. The data of it for it is a little bit further below. So you'll notice that the expense ratio on this one is cheaper, 0.13, and it pays a dividend. But the whole point of BOXX, BOXX, is to use the ETF wrapper, okay, in order not to have to pay capital gains actually on your cash. So you could theoretically stay in this ETF and pay long-term, capital gains 5 years from now if you don't need the money, right? And that way you can take advantage of the highest market rates available, and then at the end of it all, not have to pay any taxes by the end of the year, which is different than SGov, which is, short-term gains, and that's taxed at your individual income rate. So it's a tax saving tool and also kind of a smooth, give me the money right now type of deal. Because, with SGov, it's a little bit like finicky. You got to sell it at the right time. Well, I mean, not necessarily. It's kind of smooths out the process because it rises, SGov rises in value up until the dividend is released and then it drops. So as you get the dividend, so it's all kind of factored in. But the line, looks smoother. You get a better representation of what the value of your holdings actually is in your fixed income. So let's talk about this, right? So first of all, look at a smooth ride, right? How cool is that? Okay, and that's theoretically going to continue on forever. So how do they do this, right? So how do they do this? Well, they explain it in their prospectus. They talk about it right here. Principal investment strategies. So basically what they do is they will use a combination of synthetic long and synthetic short spreads at similar strike points with same duration, same strike point, and they'll do a bunch of those. And what they're trying to do, and also they'll invest in short-term treasuries and stuff like that. So it's a mix of product. There's I don't know how many holdings, 20, 100, I don't know. But they use a host of product to try to simulate and harness the basically the time value of money. Okay, so that's what you're getting. So it looks smooth, but it's just, there's a lot that goes into it, and it's definitely a very actively managed, fund, exchange traded fund. So I thought it was neat, and I might actually try it out because it looks very interesting. Now, there's a few things to note about that. Of course, the fund itself is not FDIC insured. It's not SPIC or whatever insured, because it's not. It's just a ETF, right? Your holdings are within your brokerage account. They're insured, but you're not insured against the loss in the fund itself. So you have to make sure that you know that. And there's also obviously a lot else out there that you should be learning. This is not your due diligence, right? This is not financial advice. You need to do your own due diligence. If you're confused about everything or anything, consult a professional and try to clear it up. So, please read into it. If you're interested in something like this, the yield is higher than you would get in your brokerage account and your money market account, even with like hyped up yielding vehicles when it comes to money market accounts, like the Robinhood Gold money market, or like the promotional high yield on Wealthfront. I did a video on the highest yields you can get on your cash right now, liquid cash. There's a big difference, right? You want to lock it up in some bond or CD or something like that, where it's illiquid until, well, bonds are very liquid, but I'm saying like CDs, time deposits, like they're not very liquid, and you may not be able to get your money out right away. But with savings accounts, with market money accounts, you can basically have it within a day or two, depending on who you're with. So anyway, I thought that was pretty interesting. So we talked about BOXX. Oh, the reason it's called BOXX is because they're doing a box trade. Okay, it's called a box trade. When you have these, synthetic longs offsetting by synthetic shorts. If you're wondering what a synthetic long is, synthetic short, synthetic long is basically selling a put and buying a call on a specific underlying, right? Whether it be they're using the S&P 500, I think, or SPX, and a synthetic short is basically the opposite, right? It's buying a put and selling a call. So kind of like, the theta works in their favor and against them at the same time. But because of that, it has different weighting based on the time period. And so that's how they're able to harness, the difference in time periods and really get their value from the price of time, because time has a price, right? I mean, just like any kind of bond yield, the longer you hold it, the more you get paid. So there's more value to having your money now than a year from now, because for many, many factors, right? You're removing uncertainty for once. Like if I have my cash now, not only do I not care what it's going to be worth a year from now because I have it now, but also I could do something with it, right? I could buy a bunch of candy bars and sell it for a higher price on the street or something like that, right? I just gave myself a business idea. Maybe I should do that. So I can do anything with it. I could sell options. I can do, whatever I want to do. So there's a value in time. So remember that if you're a young investor, right? But it's worth reminding, even if you're an older investor. So BOXX is the symbol. Again, not a paid promotion. Just thought it was a very interesting product, because currently, like, I'm sitting on some cash, and I'm wondering whether or not I should leave it in Robinhood's 4.65%, or perhaps SGov. But then BOXX actually gives me a good option as well. So if I'm waiting on my money, why not have it in BOXX? But SGov is pretty interesting too. So the current yield, for example, is so 5.12, and you got to subtract the expense ratio. So basically it's 4.99, which is better than Robinhood's 4.66, but not quite better than Wealthfront's promotional 5.05%. But either way, all these are around 5%. We're just talking about 0.5% at the most in difference, which is a big deal to some. I mean, if you're managing, if you have $100 million, sorry, that's a lot. How about $1 million? Let's make it more realistic. But there are some people that have 100 million in cash just sitting around, right? So they actually care quite a bit. But even just $1 million, right? That's what, $5,000 worth of difference or something like that. So it's quite a lot. So I suggest looking into it. Let me know what you think. Also, let me know if you think that there's a better product out there for short-term duration, risk-free, gain. If there is a better product, I would definitely like to hear about it. Maybe I'll do some research and make a video about it in more detailed fashion. But I want to hear about it. Let me know. We're all here to learn, me included. I'm not just some guru. I'm just a regular investor, just like you, just sharing my thoughts, and hopefully I learn from others out there in the intertubes. All right, that's all I got for you today. That was fun. Peace out.